Thank you so much for joining in this monthly webinar on our long-only PMS schemes. We'll update you with some progress on macros, how we are seeing the markets, as well as the performance of our portfolios, and talk a bit about recent changes we have made to our portfolios, and end the session with a Q&A session where you can raise your queries and we can probably give our answers to them. Before we start, just wanted to share an announcement with you. Daiwa Asset Management, which is a subsidiary of Daiwa Securities. Daiwa Securities is a shareholder at Ambit. So along with Daiwa Asset Management, we have launched a small cap India offering in Japan, and we closed our NFO in January, and we have successfully raised 1,500 crores in that NFO. This fund will invest into a GIFT City fund in India called Ambit India Ascension Fund, which will be investing in the Indian small cap space. So in this market mayhem, we have been able to successfully raise institutional money from a large Japanese asset manager. Daiwa Asset Management manages more than $200 billion of assets across fixed income and equities. Primarily Japanese, but they also have lots of AUMs between US and India. They already manage about $6 billion of Indian assets, and this partnership I would say says a lot about the processes and about the investment style with which Ambit Asset Management conducts its business. They conducted full 6-month diligence on us, and post that we started a process and set up the whole fund in a record time of less than 3 months. And within a week of NFO, they were able to raise almost 1,500 crores plus. It's an open-ended fund. Where the scheme is a bit different relative to our concentrated portfolio style of investing in the PMS side in India. Here we'll have a diversified portfolio of around 50 odd companies, given that it's small cap, given that there are daily inflows and outflows to manage liquidity, as well as because of Japanese restrictions. So we have to create a diversified portfolio. So we'll have about 50 odd stocks. We have set up a great office in GIFT City, where all the dealing, investments, management happen. And while the information is not publicly available, our thoughts, depending on the market feedback, is that this is the largest GIFT City-based active fund on Indian equities, and the second largest fund is probably a fourth of our size. So it's definitely a great beginning for Ambit Asset Management in a new chapter, and we look forward to many more such partnerships in the future. Hopefully, this will also add big credibility to us with the Indian domestic investors and partners. So we expect great support from and continued support from all of you in this journey going forward. Thank you so much. Just like to play a small video, and then I will hand over to my colleagues to start the webinar session.
Good afternoon. So what we'll do is we'll probably begin with, I just take you through the performance and the macro perspective, and then I'll hand over the proceedings with Siddharth Bothra to take you through the monthly newsletter that we've written on the gross margins. So obviously the month gone by, January, has been a volatile month. In fact, it's been we have seen deep cuts across the market cap, large, mid, or small. In this obviously month, the coffee can delivered 3.5% negative return versus probably a flattish for the Nifty. For the month, Bajaj, Finserv, iShares, and Britannia were the top performers for the portfolios, and KFin, Zomato, and Trent fell in the range of 19-20% for the month that went by. But from a 1 year perspective, the fund continues to deliver exceptional alpha for 500 basis points compared to the Nifty over a 12-month period. Moving to next. Good and clean, obviously has faced a 7.5% drawdown, so compared to the 3.5% for BSC 500. But if you look at the mid cap, the cuts were 9.5, 10%. So was the case with for small cap for the month gone by. Chola, EU, and TVS remains one of the good performers for us. And say CDSL, Trent, and Supreme, is where we got cut in this particular portfolio as well. Similar story here as well. In a 1 year perspective, the fund continues to deliver exceptional alpha compared to the benchmarks, and so is the case with the previous fund. Moving ahead to next, I think so emerging giants also saw some drawdowns because of the small cap being extremely sort of negative last month. Small caps is obviously has seen one of the worst month in drawdown since COVID 2020, and there are several factors regarding those. I'll talk about it when we move to the macro perspective. But in this, only MPS was star of the portfolio, delivering 30% plus earning growth for the quarter, led by very strong earning growth. Although the other two names also fell, between 4 and 5%, and the other bottom performers for us has been Imprudent, VIP, and BMart. All fell, in the range of 20% for the month that gone by. Moving ahead to the multi-cap 10x fund, similar sort of perspective out there. 9% fall in the fund for the month that went by. Chola and AU remains one of the good performers for the portfolio. Prudent, Orchid, and Trent remains the drivers for the portfolio for the month that went by. With these were quick highlights on the performance for the month because we saw the cuts across, so across a long only, and the micro marvel, the recently introduced portfolio has done. It also fell for the month went by, but obviously similar to the deep cuts across the market cap, I think so. In this case, we had two very, very strong performers, MPS and Bajaj Healthcare, double-digit returns for the month that went by. But however, similar to the other story across the board in the market, we had two, three sort of losers of 18-20% each. The point, one of the common thing that you must have seen across the portfolios is the fall in the bottom performers by 18-20%. But one uncommon theme across is, the stocks may have fallen so sharply, but the earnings growth for the recently concluded earnings growth that is still going on season, most of these companies have delivered very sharp, earning growth. In fact, on the contrary, few of the bottom performers across the five portfolios, at least one of them has delivered 20% earning growth for the quarter that has just, concluded. So essentially, this volatility has hit, across the board, irrespective of what kind of business that we choose. All businesses are obviously very strong and robust in terms of quality and balance sheet. But we think once this, sort of dust gets settled, these companies will come back, again sharply as we move forward. With that, I would probably move on from, commenting on performance to what we think and what are we seeing on ground, particularly from the macro and the valuation point of view. From macro to moving on to, this obviously month was the key focus being the budget. I'm sure everybody has got a chance to look at the budget, highlights. But two things very, very clearly came out from the budget. A, government focus moved from, capex to consumption. And two, despite focusing on consumption as a bit too in the common man in terms of taxpayers, government, fiscal prudence remains unparalleled. Government continue to emphasize on reducing fiscal deficit and also ensuring that the overall debt to GDP guidance of lower than 50% in the next 5 years remains intact. So what we're seeing is after the tax cut in the hands of common man, I think now India is one of the rare country where you will see the per capita GDP income to the absolute zero tax liability will be the range of 1 to 1 between the range of 1 to 5. For example, $2,500 or $2,800 is what we earn as a per capita income, and obviously the zero tax liability will be something around $14,000 to $15,000 per sort of per income taxpayer, depending on what kind of currency that you take. So we think discretionary expenditure items will be the biggest beneficiary of this particular decision by the government. And across the higher end electronics, and the mobile phones, along with the automobiles and travel and tourism, will be the big beneficiary from this particular big boost that the government has given. To our understanding and calculation, the consumption basket could actually see a push by 0.4 to 0.6% of the GDP, because each of these particular cuts will have a 2.5 times money multiplier effect in the economy. And even if you assume 50% of the total benefit goes into sort of into financial savings or investments in the markets, or even for that matter purchasing gold, this impact of 0.4 to 6%, 0.6 basis point in terms of net GDP impact remains a very, very buoyant number for us to look forward to. Moving ahead from capex to from consumption to capex, we think the story, this is very well known, that last 5 years has been dream run for capex in the country. Although private capex still remained elusive, primarily public capex has been the key driver for the economy. The good news is government has actually announced the capex which they will actually deliver, rather than announcing large quantum and underperforming on those points. So if you look at the last 3 and 4 years sort of capex numbers, India has maintained around 3.9 to 4% in terms of total GDP, and that's remained the case even in this particular year. In fact, moreover, if you look at the actual spend in the budget versus the budgeted number that we start at the beginning of every financial year, fiscal year, India has actually maintained between 82 to 87% on an average over the last 5 years. So even if you assume that this particular year the budgeted amount of 9 to 11% growth translate into similar kind of actual capex, we think the growth is not as tepid as it sounds or it is actually perceived as. In fact, to the extent that defense has actually seen a 13-14% higher allocation, roads and railways obviously has seen lower. But to our understanding, the most important point to note is how much of that will actually get spent and how much will get carry forward towards, which will determine how we progress going forward. And we think double-digit growth on a high base is not a number that one should be very shy of. So we think that's a reasonably decent number, not obviously very promising as 25% in the preceding years, but nothing significantly lower to write it off as we move forward in the future. Moving ahead from capex to what's happening in the market, I think so this is absolutely clear that FII has been the sharp seller in the market, and in fact in the last 3 to 4 months they have sold nearly 25 to $30 billion of net sort of out, taken away the money from the country. There are several factors to our mind which is obviously leading to this particular behavior. Currency being one of the challenges that we are facing, and when we say we as an Indian economy along with other emerging markets, the whole world is facing the currency challenges compared to dollars. Liquidity remains a challenge in obviously most markets, including the country, and which is why you saw RBI intervening a couple of weeks ago, both in terms of interest rate cut as well as the OMO operations to to boost the forex reserves. To boost the boost the FX movement in the country. Couple of other news, particularly with respect to what will Trump do in respect of tariffs as well as America First policies, has also played a important role in the FII sort of allocation in the country. Perhaps back domestically, the growth obviously remains buoyant in terms of the net inflows. We think obviously from here on the markets will continue to focus on wherever the earnings growth remains very, very clear and broad-based market, narrative driven will obviously has taken a backseat, as we have highlighted in the last 3, 4, 5 sort of new, monthly interaction. And we think going forward, earnings is what will differentiate the portfolios and the companies versus what the usual sort of, practice of, investing has been in the last 12, 18 months time frame. Moving ahead from what's happening in the flows to coming to what's happening particularly in the US, because this has been the talk of the town, particularly in the emerging markets, including the US. What will the new US president do? So the big question remains unanswered still now, because he imposed a couple of tariffs on Canada and Mexico, but obviously that was again postponed by a month. And to begin with, obviously the imposition of tariffs were 10% from China versus 25% that was earlier spoken about. To our understanding and reading, the probability of a tariff lower than anticipated could be significantly higher as we move forward. And which is what the reflection in the bond markets is also reflecting. If you look at the bond markets post the announcement of this tariff imposition, either in Canada or Mexico or China, the bond market did not react. In fact, to the contrary, it actually fell, which essentially means the market is not anticipating a significant higher tariff as in the calendar year 25, which essentially also means the interest rates that the US is now at quoting at 3 point about 4% will actually see a southward movements for the calendar year 25. So we think there is not too much to read to it. You will keep hearing and reading the noise about the tariff imposition by the US president, but we think the substance could be significantly lower, and the implications to my mind at least will not be far-fetching for emerging markets. With that, moving ahead to how the markets are moving to next, how the markets are, so looking at, so valuations obviously have lately corrected across the board, whether it's large cap, mid cap, or small caps. Nifty has, come down to again, long-term averages. We think the price to book ratio has also come down to long-term averages, around now nearly 9% premium compared to 11, 12, 15% premium a month ago. And we think this is obviously not, significantly higher compared to its own past. Moreover, Nifty for the financial year 25, to our understanding, will end at 6 to 7% earning growth. Next year, Nifty will obviously deliver a 13-14% earning growth, which we think is reasonable enough compared to other emerging markets. Moreover, the mid and small cap names will, not the whole basket, but select mid and small cap names will deliver, mid to high teens, which is exactly where the focus of the portfolio is, which is exactly how we build businesses, invest in the companies, and which is why, we continue to believe that the high quality and the low volatility businesses will outshine as as we move ahead from a meaningfully sort of unruffled weathers in the next 2-3 months as we proceed. With that, I would then like to comment my discussion on the macro piece, and I would like to invite my fellow colleague Siddharth Bothra to take us through the monthly newsletter that we had written on the gross margin. Over to you, Siddharth.
Thanks, Trilok. Hi, good evening, everyone. Pleasure to be discussing the monthly newsletter with you all. Just give me a moment. I'll put on the presentation. So, in this month's newsletter, what we did is we decided that we keep talking about how in Coffee Can and in other funds we focus on pricing power and try and find companies where we have companies with pricing power which are continuously either pushing on the willingness to pay or pushing down the cost and in a way increasing the wedge between the price and the cost. So what we thought is that we typically have around 8 or 9 factors that we look at when we look for companies and pricing power, and where we have roughly around 4 measures in quantitative, which we give different weights. The highest weight being given is to gross profit margin, and then we have another 5 on the qualitative one. So we thought what we will do is over the forthcoming newsletters, we will try and quickly cover these so that this becomes what exactly we mean by this becomes much more clear. So here we have discussed on the profit margin, gross profit margin. So there are 2 discussion points that we focused on in this newsletter. The first one was that, as you must be aware that, in our recent newsletters, we have been continuously talking about how the investing style is moving away from something, which was a very high beta, high risk on very short-term duration and a theme-based one to more like, which is where the Ambit style is, which is more low beta, the first focus being on capital protection and capital preservation, a more long-term mindset, in a way concentrated, and a bottom-up idea. It's not about chasing fads and chasing the latest trend. So in this respect, if you see this, we think is already, we talked about in our past letters how we think this trend is already on from June and September onwards. But as you may have seen the recent market moves, this seems to be now accelerating. And the difference is also visible when you look at the performance of different indices, particularly versus Nifty versus the SMID, where the more issues we are finding more on the broader market. So if you look at an aggregate basis, we had discussed it in our earlier letter as to how on an aggregate basis the Indian market's trading almost like 20, 32, 33 times X versus the Nifty, which is like say roughly around 20 times and 21 times and so on. So this typically, whenever you see a period like this, when you see concentration start increasing, we see that large caps outperform, and the SMID side either underperforms or in many cases actually sees a correction. The exhibit that you see here is you can see two colors here. One is the dotted green lines and the other one is the yellow line. So whenever the market is very broad based, that's the green dotted line. And you see during that time, what typically happens is that the mid and the small caps do much better. So if you look at the earlier one, the one just before September 2024 that we were seeing, this was a period where when you look at the large caps from a peak, large caps went up like 22, 23x CAGR, whereas the mid and small cap has almost done 37, 35% CAGR. We think this trend, like in the earlier ones you saw, is now turning, and over the next 2-3 years you will see a shift towards more large cap and quality style of investing. This is also visible if you look at how market is becoming more and more concentrated. What we have shown below is two exhibits. In the first exhibit, we have the data from when you look at on a third quarter onwards, the concentration was increasing, and when you look at in this quarter, it has increased even more. So this is we think that the investing style is now moving more towards quality, more towards large cap, and in that respect, we think that fund like Coffee Can would be able to kind of really do well in a scenario like this. Now coming to our main discussion point, which is on gross profit margin. So we have called essentially. What we have done here is that we first try and discuss as to why pricing power companies, and then come to the gross profit margin. So in this newsletter, what we did is we came across this research paper from one of the Bloomberg research paper, where they talk about how they've actually launched 3-4 indices globally in US and in other places in Europe, which they call Bloomberg pricing power, and they have used a very simple formula for coming up with these companies, and they just call it stability of gross profit margin. So what way they do essentially is they take 5 years gross margin for companies which are in the top 500, 600 companies of the country, and then they do a standard deviation of the same. They take out sectors like say the BFSI or any lending ones, or sectors where essentially there is no concept of a gross profit. I mean, there's no concept of a raw material or similar thing, like where the gross margin would be almost like 90 or 100%. And they also take out some of the most levered company. And post doing that, they sorted by the lowest standard deviation for gross margin, and they come up with a company, a set of top 50 companies, and they do an equal weight across those top 50 companies. The empirical research in this paper shows that having done so over the last 18 to 20 years has beaten markets handsomely, both in US, in Europe, and so on. So we thought we will use this and discuss as to how just one measure of pricing power that we talked about, out of the 9 measures we took, take just one quantitative factor, which is the gross profit margin, how it's so important. So why do we look for companies with pricing power? This is very clear that, essentially, when you look for pricing power stocks, they typically give you higher returns. They are more stable, and often these are companies which work on the background. They're not talked about much, and across cycles, they have the lowest volatility, and on a risk-adjusted basis, they often give you better returns. Now, why look at the gross profit margins as the key thing? So the reason for looking at gross profit margin rather than say an EBITDA or a PAT, firstly, is that when you think of an EBITDA, there are so many line items where the interpretations could differ, and hence the numbers can be like the numbers can make us there could be some significant impact depending on how you're interpreting things. Similarly, at the PAT margin level, there's so many accounting things, or there's so many measures that you can take where you can change these numbers, but gross profit as a metric is very difficult to move. So typically, whenever you see companies with very high gross margins of like 40-50% and which are very stable, these are companies which are essentially in an industry which is very stable. These are companies where they have found some pricing power, or they are inherently stronger companies. This is not to say that if pricing power, if your gross margins is low, it necessarily needs to be a bad company, because it has to be seen in the context of that particular industry. To give you an example, like if you look at an Avenue Supermart, their gross margin would just be around 15%. But this 15% on an industry basis is amongst the higher ones. Similarly, for say someone like Titan and so on. So when you're looking at this, essentially the thing is that there's this data which shows how this single index built by this single metric has kind of outperformed across markets in different time periods. And this is just taking you through how this particular index is made, which is you essentially looking at the Bloomberg US large and mid cap index. You ensure that the 90-day trading average of them is above 10 million. You remove the unprofitable companies, as I mentioned, remove the companies which don't have 5-year history, and eliminate the 10% of companies with high leverage, and you select the top 50, equal weight them. So the companies you see below are the ones which have come in this study across in maximum time. And these are essentially companies which come in consumer staples, often in healthcare, industrials, companies like say, whether it's Walmart, whether it's like a consumer discretionary like Tractor Supply, Dollar General Corporation, which is a staple company, and so on. So what we did in this newsletter, just to get a sense of how this particular thing would have worked in India, we applied the same metrics in the Indian market and took companies which have more than 10,000 crore market cap, which would roughly give you the top 500 companies of India. And the table below that you see is the breakup. So we applied it for 3 years. We did the same exercise for 23, 24. And as you know that in 25 we are yet to finish the fourth quarter. So this is more like a last 12 month. And this data was taken on 22nd, 23rd of Jan. So, whatever results had come, that would be for 9 months, or it would be for 6 months. So if you see, just like in US also, the maximum number of companies that fall in here is from the, healthcare, industrial, and the consumer, staples and the discretionary side. That's been the broad breakup. In India, the breakup between, if I were to look on a market cap basis, would be like 10%, would 10 companies are in large cap, 13 in mid cap, and 27 in small cap. So these are the names of the companies which came in different studies. And what we did is that for the year 25, we also gave the standard deviation and the total absolute return for the last 5 years. So the important thing to note here is that if you look at the average of the top 50 returns for the 5 years, it's almost like 3x of the Nifty 500 returns, and much more than the Nifty returns of 90% over the last 5 years. And many of these companies, in fact, 30 companies, are companies which got repeated in all the 3 years. So the brown color that you see, these are companies which have got repeated in all 3 years. And the so-called yellow color is companies which have come in 2 years. And the ones without any coloring are the ones which have come only in that year. So if you look at this year, there have been many new additions like, there's Poly Medicure, there's ITC, there's Crystal, there's Oracle, there's Jubilant Foodwork, there's SKF, there's Emphasis, and so on. So this just gives you a sense as to, how, by using a simple metric like gross profit margin stability, you are able to kind of more or less come up with, some of the best names on the pricing side. So what we did is here, we did the similar thing. We figured out the companies which came in all 3 years. And, we noted down the ones 6 in the large cap, 6 in mid cap, and 6 in small cap. So if you see in the large caps, the companies which have come repeatedly are companies like Hindustan Zinc, Torrent Pharma, Coal India, Adani Ports, Mankind Pharma, and DMart. Whereas in the mid-cap category, it's RVNL, Abbott India, Colgate, AIA Engineering, Page, Indus Towers. And small caps, you have companies like JBM Auto, JB Chemicals, Kaplan Point, Sublin, Carborundum Universal, and Naveen Flooring. So while this exercise of stability of gross margins works very well, there are as we had mentioned that in our case we actually go through 4 such quantitative and 5 qualitative parameters to come up with our this thing. But one of the key drawbacks here could be that often companies where gross margins are increasing, they also end up with a higher standard deviation. And as per the rule of taking only the top 50 with the lowest standard deviation, they get missed out. So if you look at some of the names which got missed out from the table in the top 50, where like Elecon Engineering, Newgen Software, where the gross margin on a 5-year basis improved sharply. And we took, but they were still very stable. So the standard deviation was less than 5. And, the returns here were significantly higher than the returns that we saw in the earlier table. So, just to conclude then, the first point that we have been talking about for some time, that post-COVID, the market style is moving more towards long-term, serious, disciplined investing style, which is what, at Ambit Asset Management, our focus on, more quality and so on. That's exactly the kind of a long-term kind of a mindset and long-term investing style we have. And the second point is, when looking at a company's financial profile, gross profit margin is perhaps one of the most important metric. And, when you find companies where they are high and where they are very stable, it's one of the first indicator of a company which may have pricing power, which you need to, go through other data points and studies to figure out. And lastly, at Ambit Asset Management, our focus continues to remain to find companies which are forming the widest wedge between these two, and look at companies where the pricing power is not only there but it is increasing. So these were some of the points I wanted to discuss on in this monthly newsletter we did. And as I mentioned, our idea is that over the next forthcoming whenever we come up with these newsletters, we would try and cover all the 9 aspects of pricing power that we typically look at.